Hi there Internet, my name is ᴄᴏᴘᴘɪᴇ and I'm one of eToro's most copied popular investors. Today is Friday, the 16th of April, and that means two things. It is time for my weekly update, the week in review, and also it is my 10-year wedding anniversary. This week we're going to do a slightly different review on account of a number of questions that I'm getting, but also because I'm not able to communicate with my copiers as much as I would like to at the moment. Okay, let's jump into it. Alright, so starting with my stats as we usually do, my stats have stayed almost exactly in place, and this is one of the reasons that I'm getting a lot of the same type of question right now, and that's why I'm going to choose a slightly different format of session today. So I've had many copiers join in the past month or 2 months. Thousands of you, thank you for joining the copy, but a lot of you are now asking why the copy of me is not moving, and this happens from time to time, but especially in light of the fact that on the 1 month time scale, indexes such as the S&P 500, the Nasdaq, and the Dow Jones have been, doing quite well. Particularly the Nasdaq, which has recovered and is now past or at the all-time highs that it set earlier in the year. So the thing that I wanted to look at quickly is when you are looking at my or any popular investors' stats, you want to look at their returns on different timescales. So on this chart, we have the S&P 500 as represented by the candles. We have me as represented by this line. We have the Nasdaq in blue, UK 100 in orangey red, and the CQQQ, which is an ETF that wraps some of the largest tech companies in China. So right now we are looking at the time frame, which is just the end of 2020, start of 2021, through to current time, obviously. And you can see that CQQQ, I'm just going to call it Chinese tech for now, had a bit of a melt up earlier in the year and then dropped off significantly, so it technically entered into a bear market. If we zoom in a little bit more, you can see that so the S&P 500 has done particularly well through this year, outpacing most other indexes, and for a while I was beating most of the indexes, but now the likes of the S&P 500 and the Nasdaq are caught up. Again, this doesn't worry me. This is a very short time frame to look at. And if we zoom out a little more, you'll see that I'm still way ahead of my benchmarks, depending on the longer time frames. So that's an important thing to do for me and for anyone else. Don't just look at the week, day, or the month. You want to have a look at the quarter, but almost more importantly, you want to look at whether a PI has performed consistently well over a number of years. I would say at least 3 years and preferably a 5-year time frame. Okay, so despite things being flat, as you can see, this is, let's say, the middle of February through to now, so nearly 2 months. Before that, we've seen a big climb, and I have no doubt that'll happen again. All right, so what I've done is I've taken my entire portfolio and I've broken it into the themes that I use as part of my investment strategy. So going through the spreadsheet very quickly, there are 9-ish themes, more than I would like, but I'll consolidate some of these themes in the coming probably 1 to 3 months. Right, so themes are: 1, big US tech, and this is a fairly large chunk of my portfolio. You'll find that for most PIs, this is a much larger part of their portfolio. And big US tech has done very well through the first quarter, and I think they'll do well through the second quarter too. So they've earned us a good profit, and they've been keeping the portfolio buoyant. So this theme is currently in action. The second theme is big US finance. So I've got American Express. I've thrown in AIG, which kind of fits into this group, and also some of the big banks. I'm not going to go into deep dive about why I selected all of these. I'm just going to talk through what they are and how they're doing. So not the biggest part of our portfolio, but I expect this to do well through they have these banks have reported excellent earnings, and I expect them to do well through June when they start doing their big buybacks and increasing the dividends. Theme 3 is silicon microchips, and there's a massive chip shortage globally. It's a massive problem. Countries are pouring investment into it, so I've wanted to take advantage of that, a fairly big part of the portfolio. Green energy is a part of the portfolio that has underperformed, and I will do a deep dive on this one, but it's a fairly chunky part of the portfolio. Another big theme is Chinese technology businesses, and I think it might be the second biggest. It's one of the biggest parts of the portfolio, and this has significantly underperformed. This theme has encountered several challenges over the past month and a half, and I will deep dive on that one. Commodity super cycle and some inflation hedging. So these have recently started performing, but I will continue to hold these for a few quarters. It's slightly red now, but I expect that to change as inflation becomes a bigger concern. UK recovery, so another big part of our portfolio. UK recovery, I'll deep dive this in a moment. It started kicking off earlier in this year, but has had some setbacks. Next generation industry leaders, a fairly small part of the portfolio. I've kind of grouped Corsair in here, but I don't actually think of it as a next gen industry leader, but I just chucked it in there. And then the last theme is value and recovery. So these are stocks that I think some of them are deep value, and some of them they'll benefit because they're value companies, and I think they're undervalued. And through this year, as inflation increases, I think we will see net inflows to some of these companies. So another fairly chunky part of the portfolio, and doing quite well at the moment because of the rotation that we've seen from technology growth into value stocks. And then there are a few others that I didn't really categorize, but I'm not going to talk about those in too much detail. So let's look at the losers, because those are the things that have kept us back. So as we can see here, over 2 months, some of the indices, especially the Nasdaq, took a bit of a whacking, and then recovered. And we haven't enjoyed, part of our portfolio has enjoyed the recovery, namely big US tech, value, microchips, but then some of it has been lagging. So green energy, that had a fantastic run through last year, was overvalued. So, but not universally. So even within my portfolio right now, I would say Sedge, Solar Edge Technology, is still a bit overvalued. Enphase is a bit overvalued, but I think that these still will perform well towards the end of the year. The wider energy sector has had a big drop off through the past couple of months, and this is for various reasons. A world that isn't opening up as fast as we had thought needs less energy immediately. So there was an anticipation that the world would open up sooner, and then we had all the debacles around the vaccinations, or the problems around the vaccinations, which meant that the anticipated requirement for energy will be pushed, the can will be kicked down the road a little bit. So I don't really have any concerns about these. Sage is probably the most expensive in this basket. First Solar is fair value right now, and I think that the stock will do very well. Canadian Solar is fantastically cheap. It is, I think that this could be a multi-bagger through the next, let's say, 12 to 24 months. So despite this being a fairly large part of the portfolio, there has been some drawdown, which has held the portfolio back. I don't think it is completely rational. Well, it's partially rational. It's true that the world won't have the energy demands that we anticipated in June or July, but those energy demands are going to be there by the end of the year. So I don't think this theme has failed. I think that the timeframes have just been pushed out. The second one that I wanted to look at is Chinese technology, and this arguably has had the biggest effect on the portfolio. So for two reasons: the drawdown is the biggest, and also it is quite a chunky part of the portfolio. For anyone that's been following, the Chinese economy is in the midst of a massive revolution. Not just the economy, the society. So the government has been imposing all kinds of legislation through the past 2 years around how companies interact with the society in general, which is good for the country long term, and for their society. The Chinese stocks had a fantastic run last year. Investors poured in because the Chinese economy had positive GDP growth through last year, which was very different from the rest of the world. So investors were betting on that economy. And then there was a melt up. Melt up, by the way, is when stocks just they rally incredibly in a last push before they ultimately fail. So that happened through the early part of this year, and then investors got really nervous. The bond yields in the US were part of that scare. Regulation in China was part of that scare. Big cases against big tech were part of that scare. So, for example, the government looking into Alibaba and other companies as part of the antitrust lawsuits. So there were a whole bunch of risks, or perceived risks, that happened more or less at the same time, and they popped the melt up, the little bubble that was there. The Chinese government has also said they're tightening up lending through this year, and the impact is that high growth companies, which need lots of money to survive, will have to pay a little bit more, or look a little bit harder for the money that they need to grow. So that was unforeseeable and unfortunate, but the companies that we hold are fantastic businesses. So if we take a look at this chart here, so CQQQ, Chinese tech, you can see that it rallied massively through last year, but then particularly through the first 2 months, and then dropped off more than 20%. So the thing that we need to bear in mind is that this stocks within this index are in a bear market, and it feels as though they found a bottom, but investor confidence has taken a knock. So anytime you have a correction or a bear market, it takes a while for that market to start feeling confident again in the companies within that economy. Now, this kind of thing could happen to the US market. It will happen to the US market, the UK market, any market at some point. The reason that I don't try to jump out or try to anticipate when this is going to happen, and you don't know when it's going to happen, no one can predict when it's going to happen, is that I own companies that are more likely to be successful than others in that market. So the companies that I have here, even though some of them are massively down, and I'll take a look at it at the moment, I'm still very confident that they are multi-baggers. A multi-bagger, by the way, is a company that is expected to increase several 100% over some time frame. All right, so this has held us back, and it means that my benchmarks have caught up with me, but I also expect that when big US tech and the US in general starts to falter and has a bit of a difficult time, that companies within the Chinese economy will be outperforming. All right, so you can see that some of my holdings are deep in the red. So companies like Zepp and Douyu, so these are Chinese businesses. You'll see a theme. These are all Chinese businesses. But if we take a look at a few of them, for example, Zepp is a company that just rebranded, so changed their name. This company is incredible. They've rebranded as a healthcare technology kind of business. They make a number of devices under their own brands, but also in partnership with Xiaomi. So the gear that they make is very, very well received. It's bought throughout Asia, including India and parts of US. They've just released some new versions of some of their products. So I think they did have an okay-ish earnings report last quarter, but I think this was partially because they just rebranded and they were trying to find their footing as this new healthcare tech company. But on top of that, they were a victim of the upgrade cycle. So people weren't buying older versions of their products in anticipation of the newer versions being released, which they now have. So I think this quarter could be very good for them. So even when Zepp was at this price, so the recent all-time high, it was undervalued. It was, in my opinion, a multi-bagger from this point in time. So what we can see here, and just look, I'm not going to go into a deep dive. We've got a company. By the way, I think this market cap is off. I think the market cap is less than this number says. So the revenue and the market cap of this company are the same. This is a rare thing to find in this kind of company. We can see that the compound annual returns on revenue are 48%. This is a company that's growing fast, so fast. If we look at the 3-year compound annual growth rate on sales and also profit, this is nuts. So it's rare to see a technology company of this kind growing as fast as they are in terms of revenue, but also in terms of profit. However, despite this massive amount of growth, the fact that the company has, by the way, these numbers are on one down here, despite having no debt, cash on hand, a massive partnership with one of the largest technology companies in Asia, growing sales and earnings, things like their PE ratios, if we look down here, are fair valued, and looking forwards, they are dirt cheap. PG ratio, dirt cheap. So this is a company that is a fantastic business, growing very fast. I think it might accelerate its growth in the near future, but has lost half of its share price in a month and a half. Absolutely nuts. Now, I mentioned before that the Chinese government is looking to curtail risky lending within the economy. I forgot to pull up the article, but the GDP numbers out of China just came in this morning or last night, and the Chinese economy in Q1 of this year grew by 18%. The economy is firing on all cylinders, and this is part of the reason that the Chinese government is taking these actions. It's very wise, it's prudent. So they see that the economy is growing like crazy, and they don't want bubbles to form in their economy so that it collapses 1 year, 1.5 years, 2 years, 5 years down the line. So they're taking actions to make sure that the high growth that has happened in their economy is sustainable, which is fantastic. It's quite a different approach from a lot of governments around the world. So this has affected sentiment in the short term, but it has created incredible opportunities. And so this is why I am happy to hold this company at minus 32% in my portfolio. Now, a lot of you might be asking why I am not buying more if this is such a good opportunity. And the reason is because I'm waiting for sentiment to bottom out. This represents a fairly chunky part of my portfolio at the moment. If it goes lower, I prefer to protect the rest of my portfolio from further volatility within these companies. So I will wait for a reversal of the trend, which effectively just means I'm going to wait for sentiment within the Chinese tech to turn a corner and become positive, and then I will definitely be loading up on some more of these stocks. For this company here, I recommend that you look at Ishfaq's analysis of the company. It seems that him and I do a lot of very similar styled analysis on our businesses, and we have some overlaps in the companies that we absolutely love. So if you take a look through what he has to say about the company, he's very balanced in terms of his reviews. So you will see the risks laid out when he does his reviews, and I completely agree with him in this case. So this is the Twitch of China. It's about to merge with its biggest competitor, effectively. Tencent has a stake in this company, and it is another business that, even if that merger doesn't happen, there's an antitrust probe, by the way, into this merger because it would make the company so big. But even if the antitrust probe were upheld and the company was not allowed to merge with that other business, this company is so incredibly undervalued. It is insane. Okay. And this is a similar theme for lots of the companies that I hold. Baidu is a slightly different case. They are still very good value. I've held Baidu for a number of years. The stock price was affected by the Archegos debacle that's happened over the past few weeks, where massive chunks of Baidu stock were sold at a major discount to market value just because they had to sell them. And this drove the prices down because of the discount that they've been sold at. And it's emerged that actually more of these stocks, Baidu and some of its subsidiaries, have been sold through this week, keeping that price low. Baidu, by the way, is similar to Google within China. So, long story short, Chinese tech hasn't done very well through the past quarter. I still have complete faith in this theme. I think this will be the strongest growth engine of my portfolio through the next year and through to next year. It's taken a beating recently, and that's a large part of what's been holding us back. But sometimes it happens. So there's been a bit of a delay in the success of this theme, but it's just a delay. All right. I also wanted to look at one of the stocks in green energy. So Canadian Solar, another company that's been a little bit hurt. So Canadian Solar, as the name implies, is a Canadian company. In 2018 or so, the trade wars that were started by Trump and co. Affected more than just relations between US and China. They also affected relationships between the US, Canada, and Mexico. And so I think it was around 2018, I'm not sure at what point, that tariffs were imposed on imports of solar products from Canada. And this reflects the little bit of a dip that we saw in revenue for Canadian Solar in 2019. 2020 also posed some challenges for them. I'm not sure if everyone's aware, but installations of certain types of solar technologies and other green energies were difficult because people weren't allowed to mingle and do business in person. But the net effect of this is that we have a company whose revenue is significantly larger than the market cap, whose growth, these are forecast numbers, by the way, 2021 and 2022, whose forecast growth is enormous. So through 2022, we're looking at potentially doubling the revenue from this point. Earnings have been affected by various issues recently, but by 2022, we're looking at a 58% uptick in EPS growth. So in terms of when comparing within its industry and the wider market, the company is more than fair value. They know how to turn a profit, and they've got lots of cash on hand. They're carrying some debt, which is typical for this kind of company. They have to buy the stuff that they sell, so they do usually carry a bit of debt. But we have a company that is looking incredibly cheap, that is growing fast, that was hurt by a bit of a tariff war. By the way, the Canadian government has earlier this year, appealed to the US government to remove tariffs on solar imports from Canada. I'm not sure if that's going to be successful. It might take several months if there is a positive result there for it to emerge. But even if it didn't, Canadian Solar is an international company. It doesn't rely solely on the US for its revenue. And so again, we're looking at a company that is cheap, has lost from its all-time high, has lost a significant part of its market cap, is going to grow through the next 2 years massively, especially because many countries around the world are investing in infrastructure, and particularly in green energy, decarbonizing. So I waffled on a bit there, but by my enthusiasm, you can probably tell that I'm very excited about these two themes. It's disappointing to me that there have been things that have held them back, but the strategies are still sound. There has just been a delay in the time frame in which they are successful. But that happens. We can't always time the market. I wanted to touch on UK recovery stocks too. So even though they're flat, I consider this an underperformance. A lot of these companies were doing very, very well earlier in the year. So the reason I'm bullish on UK recovery stocks is because the UK vaccination rollout has been better than in many other countries through Europe. And a lot of these stocks are mostly involved in the UK domestic economy. So I invested in them thinking that if there was an issue in the wider European rollout, that they would more or less be insulated. At least the business operations would be insulated from any issues that happened in the vaccine rollout. Some of them rely on, obviously, international travel being available, the airlines being those. But when it emerged, I guess in February of this year and March of this year, that the European vaccine rollout was really being hampered, having a material effect on those countries opening up, it affected not only UK stocks, that UK businesses that were involved in international travel, but it also affected sentiment around all recovery stocks. And so a lot of these companies have been flat or negative through the first quarter when they really shouldn't have been. For example, I don't know if anyone in the UK has been out recently, but the Wetherspoons around the country are absolutely rammed. So when earnings come out for some of these companies, I think the picture that we're going to see is very, very optimistic. EasyJet reported recently, and their numbers were very good. You would have seen a recent pop in their share price. So I think there's been a bit of a delay in these stocks, these companies doing very well. A lot of that has been sentiment that's leaked out from Europe because of the vaccine rollout into UK sentiment. Again, I'm not too concerned. These are a fairly short-term play compared to my Chinese tech and green energy. I think, so this is one of the themes that I will collapse probably by the third quarter of this year, maybe the fourth quarter of this year, taking all of those profits and then pouring those into other themes that currently exist. Okay, so where do we go from here? Just to zoom out a little bit. So here we have my return every month that I have been on eToro. I'm not going to talk about 2018. If you look at my intro video on my YouTube channel, you'll see I explain what mistakes I made there and how I will avoid them in the future. But you'll see even through the rallies in my portfolio, there are a number of times when there are months when things are flat, right? So here, and even more recently, well, March 2020 was a special occasion, but before that, 2019, you can see between these 2 months took a dip. Between these 2 months took a dip and stayed flat. Towards the end of last year, took a dip and stayed flat. And now we're in a flat period again, so the portfolio has plateaued. I know that it can be frustrating, especially if you are newer to the market and you're looking at these numbers and they become enticing. I hope that they are enticing, but we can't always determine what's going to happen in the market next. And so there are people that they copy here, and they need to sit in red for 2 months before the portfolio takes off again. So I'm not particularly concerned. All right, I'll share this link. This is a fact sheet that eToro makes available. So these are not numbers that I generate. eToro generates these numbers and makes them available to copiers and potential copiers. So you can see that it's effectively an audit of my returns. And yeah, that's about it. So a slightly different format for the review today. Next week, I'm not going to talk too much about what's going to happen next week. It's going to be dominated by earnings. So we can see lots of companies reporting through next week. I hope that for those copies that are newer to the portfolio, that has helped you understand more or less where I am in terms of my portfolio and my strategies. We've had some delays. It's fine. Those strategies are still intact. Sometimes, things don't always go the way that you want in the time frame that you want, but eventually we'll get there. Okay, thank you very much, and I will speak to you soon. Goodbye.